Hi, this is Alessio, your Rastani leading trader. Hope you're well, and welcome to this week's update and outlook on Bitcoin. Now, Friday's sell-off on Bitcoin, as you can see here, certainly managed to freak out and scare a lot of traders, a lot of Bitcoin investors and traders. But I want to show you, actually, this drop that you see here was actually quite normal and actually nothing really to be scared about. Now, let me just put this into context. You see, in early April, we formed this bottom that you see here, this low, and then we managed to have a nice rally off that bottom. We went to these highs near just about the 9600 level, and what we've seen so far, let me just bring this a bit closer. What we've seen so far is after this rally, it appears that we're now making a correction, a pullback, and as you can see, it rested right on top of that 200 moving average, that green line you see right there. As a matter of fact, it held that level very nicely. Now, I'm making this video right now on a Sunday, and as I can see right now, over the last couple of days, prices have managed to recover. So Bitcoin prices right now, as I'm making this, have managed to recover and bounce, and we're now above the 8600 level here. Now, there is a second reason why that is significant, so let me just explain that. You see, on most charts, there is a tool that you can actually find. Again, this is on most charts, called Fibonacci retracement right there. So we want to grab that, and what we want to do here is just click, left click, and then draw it from the low, okay, from the significant low to the most significant high right there, okay? And then what you can see that this tool shows to you these important levels on your chart. And the levels I look at specifically are these 38.2 and the 61.8%. All right, now these are what's called the Fibonacci ratios. Actually, this is also a very important ratio, 23.6, but for me, these are the two most important ones, 38.2 and the 61.8% Fibonacci ratios. Now, in case you're not familiar with what Fibonacci is, no, it's not some Italian pasta dish, although that would be nice. Actually, many years ago, I would say about centuries ago, scientists discovered that there are certain numbers in nature that are not arbitrary, they're not random. They actually have a special meaning. There's something special about these numbers. And they found that certain ratios in nature have this specific sequence, this number, this ratio. For example, the ratio between your hand to your arm is based on this ratio, the 38.2 to the 61.8%. Same goes with the ratio of your joints on your fingers. Again, 38.2 to the 61.8%. Now, just to quickly explain a bit more about these Fibonacci sequences, the Fibonacci ratios, the idea is that after a market rally like this, okay, price often retraces 38.2% of its previous swing high, okay, of its previous rally. All right. Now, sometimes the correction or the pullback or retracement, if you want to call it that, can be a bit more than that. It could be 61.8%. Okay. So these are the typical ratios: 38.2% retracement to the previous rally or 61.8% of the previous rally. Again, remember, these are Fibonacci sequences, Fibonacci ratios. They're not arbitrary. They're not random. They're actually significant in nature and, of course, also in the markets. And the idea is, the theory goes, that after these retracements, whether it's 38.2 or the 61.8, the market then usually continues its former rally. In other words, it continues to move in the direction of the previous rally that we had there. Okay? And by the way, some of you are probably asking, well, what about the 76.4 or 78.6? I'll come to that in just a few moments. Now, so what we can see here, Bitcoin has managed to make this rally. So Bitcoin has managed to now retrace down to the 38.2%. As I just said, it's also managed to bounce from that level as well. Now, this is actually important to appreciate because, firstly, that could essentially mean, that could be the sign that we're heading for a continuation move higher. Okay, but it's possible some of you are probably asking right now, and it's a good question to ask, well, what happens if Bitcoin continues to move lower down to its 61.8%? In that case, we need to see buyers stepping in and actually holding that level. Let me just change the color of this. This level is going to be very important, the 61.8%. If Bitcoin fails to gather momentum and fails to continue moving higher, and if it instead comes back down to its 61.8% Fibonacci ratio level, which, by the way, right now is seems to be about 7,700 by the looks of it. All right. If it comes down to that level, That's going to be the last bastion of support for Bitcoin. Okay, what must not happen is that Bitcoin must not fall below that level, below the 61.8% level. Because if it does, that increases the probability of a move down to these lows of February to about 85 to 90%. All right. In fact, we've seen many times that when price drops below a 61.8% Fibonacci ratio, that opens the door to a great probability of a move down to its previous lows. Now, I know there's some people watching this video, probably Fibonacci purists or fundamentalists, all right? And I'm sure they're shouting at their screens right now and saying, hang on a second here, that's all wrong. Because what about the 76.4 ratio? What about the 78.6% ratio? Yeah, good luck with that. You see, guys, what happens is a lot of folks go and read these books about Fibonacci and, about chart analysis, and they read about these different ratios like 76.4, 78.6, and they think that these things really are important. The markets have changed and evolved a lot in the last few decades. So, yeah, look, put it this way, guys. Here's why I don't really care about those specific and I just want to burst the bubble of anybody who thinks that those specific numbers, this specific ratio matters. I don't really care about the 76.4 or the 78.6. Here's why. As I've just explained, by the time price drops below the 61.8%, when we fall below that, the odds greatly increase of a move down to test the previous lows. All right? I don't really care at that point. If price drops below the 61.8%, I don't really care about staying in the market. In other words, I don't want to be in the market. I want to be out, because that essentially increases the risk of a trade that's going to go against me, of a movement that's going to go against us. All right? And I don't want to be in that. Let me just give you an example. I wonder if you can remember what happened during the World Cup in 2014. Now, by the way, if you don't watch soccer, if you don't like the World Cup or football, then you might find this example a bit boring, but I still encourage you to learn from this example. You see, guys, back in 2014, you may remember what happened. It was the finals of the World Cup between Brazil and Germany. You might remember that. And by the way, if you're a Brazilian, I'm really sorry to bring up this really horrible nightmare as a memory to you. And I don't want to remind you again of that horrible day. So I do apologize about that if you're a Brazilian. But if you remember, it was a terrible day for Brazilian football players because the score was 7-1 to Germany. Germany was scoring 7-1, and of course that's the score they won with. But here's the thing, guys. By the time Germany was winning against Brazil by 4-1 or 5-1, we already knew the game was over. But by that time, it was a disaster. Right, guys? So if the score was 4-1 or 5-1 to Germany, I'm not going to go and place a bet for Brazil to win because we know the game is over. That's crazy. I mean, that's insane. Who would do that? Same thing with this. By the time the price has retraced below its 61.8% level, as I just explained, the odds greatly increase that we're going to go head back down to the previous lows, and we may even go below that level. All right? So, no, I'm not interested in being in the market and holding my trade, holding my position once the price has fallen below the 61.8%. Again, that's a bit like betting on the losing team when clearly your losing team is losing. All right, so this is what I'm talking about. So guys, bottom line is that I don't really care what the textbooks say. I don't really care what the purists, the fundamentalists say about Fibonacci. Once the price has fallen below that level, I'm out. I don't really care. I'm not interested. So yeah, good luck with the 76.4, 78.6%, whoever likes that kind of stuff. Bottom line is this, guys. These are the two levels we want to watch, the 38.2 and the 61.8%. Good news is, guys, as I'm making this video, that Bitcoin has managed to so far, come down to the 200 moving average. We managed to bounce off that level. And again, as I just explained, we're actually above, let me change that color. We're actually above these 8600 level there. Let's see if we can maintain momentum and actually move higher above that. All right. But so far, so good. Buyers have stepped in and the 38.2% is being protected, which is exactly what we want to see. But as I've explained before, if the rally fails and if we fall back below that 38.2, if we fall back here to the 61.8, that's actually a warning signal because we must not fall below that level. Okay. We must not fall below that 61.8 or the 7700 level. Because if we continue to fall below that level, in a previous video that I made, and again, if you haven't seen it, go ahead and watch it again. It's the one here. It's called The Dangerous Pattern Bitcoin Must Avoid. In that video, I explained that one of the symptoms of an unhealthy market one of the symptoms of a market that's going to drop and potentially drop significantly down further is what's called failed rallies. And you can see this what happened many times before to other markets too, and including Bitcoin as well in the past. When you see rally and then a failed rally, rally and then another failed rally, and another failed rally here's again. So the failed rallies, guys, is a terrible, terrible sign for the market, for any market. You can see that so far we've had one rally which has failed, and this is the second rally. This rally must not fail, because if this rally fails and we fall back down to the February-April lows, there's a good chance we might actually break that level. All right, that's for the reason I've explained. Failed rallies is not a good sign for a market. All right, so we want to see this rally gathering momentum, and we want to see this pushing higher. If it fails and we fall below the 61.8% level, then that will increase the probability of a move down to the February-April lows. And again, if we fall down to those lows, we must not break that level, because that would be breaking market structure, which of course will have devastating consequences. All right, guys, so far so good. And I hope this video helps. And guys, if it has helped, please give it a thumbs up. And also please remember to subscribe to our videos for future updates as well. Thank you very much indeed. And I'll see you guys in the next update.